Well, good afternoon, everybody, and welcome to the inaugural annual member meeting for members of Catholic Super, MyLife MySuper, Transport Super, and MyLife MyPension. We are delighted to have so many of our members joining us today, and also that we can have members with us from all the different superannuation funds and different brands that we represent. I'm Andrew Fairley, the chair of the board of the trustee for all of those funds that I've just mentioned, and I've got the honour of being able to welcome you and outlining to you what it is that we're going to cover in this first of our annual member meetings that has ever been held. It's really quite exciting. On behalf of my fellow board members and our executive team, I want to thank every one of you for taking the time to actually log in today and to be part of this special event. I want to introduce our board to you. They're just such a key part of our stewardship, our governance and our success. Our deputy chair is Danny Casey, and Danny's going to speak to you shortly. But I want to confirm, I'm very pleased to confirm that Danny is going to take over the role as chair of the fund as from 1 July next when I retire. The board is absolutely delighted and privileged to have somebody with such strong experience and leadership credentials to steward your fund forward. Now, let me speak just of our other directors. I'm just going to give you a little bit of a soupçon of who they are and their skills. Justine Hickey from Brisbane, who's the chair of our investment committee, who you will meet later as part of our Q&A. Penny Davey-White is a communications and marketing expert from Canberra. Carolyn Harkin has a strong finance background from regional Victoria. Jan Decker is an experienced investment professional from Melbourne. Mark Kershay, one of Australia's leading superannuation lawyers. Michael Clinch from Melbourne, an HR professional and an executive with AGL. Peter Hazy from regional Victoria, very experienced and long-serving trustee director. Simone Thompson from Northern New South Wales, who's an expert in governance and compliance. Deb James from Melbourne, who's the General Secretary of the Independent Education Union. And David Doolan, also from Melbourne. And David joined our board last year. He's a former senior finance executive with Rio Tinto. So it's a very talented board with the skills that we need to ensure that we manage your fund appropriately. I can confirm that we have a quorum of directors as well as our auditor and representatives from APRA. And as such, I've got a great pleasure in declaring that this annual member meeting, our inaugural meeting, is officially open. In doing so, I want to acknowledge the traditional custodians of the land on which each of us are meeting today. We pay respects to elders past and present, and we celebrate the continuing connection to country of Aboriginal communities. Of course, normally when we're acknowledging traditional owners and custodians, we're standing in a specific place, but this is very different in COVID times when you are spread out all over Australia. So acknowledging our traditional custodians around Australia, I want to reference this map from the Australian Institute of Aboriginal and Torres Strait Islander Studies, which provides a great overview of the extent and richness and diversity of the Aboriginal communities throughout Australia. While I'm based in Melbourne, the people you'll be hearing from today are geographically diverse in Sydney, regional Victoria, and in Queensland. I know we have members joining us from many different locations throughout Australia. I want to make sure you're aware that the information in this presentation is general in nature and is about the fund as a whole. It doesn't take into account your personal circumstances, your individual investments, or your financial objectives. If you'd like to have individual financial advice, then we have advisors who can assist with that. And at the end of the presentation and the meeting today, we'll include their contact details on the screen for you to be able to make a connection with them. Let me talk a little bit about what we're going to go through today in our annual member meeting. Firstly, Danny Casey, the Deputy Chair, will make some remarks on behalf of the board, including an analysis of the history, the vision, the overall performance, and a look ahead at the future strategy and changes in our industry. Then Scott Cameron, our CEO, will speak, and he'll cover the high-level financial performance, make some comments on operations and how we've been able to assist members through a very difficult year. Then Anna Shelley, our Chief Investment Officer, will give further details on our investment strategy and our performance, and make some comments on the current economic environment. We'll then have some questions. Those questions are the ones that you have submitted. We've received a lot of questions before the broadcast, the webinar started, which is terrific because it demonstrates that you're really engaged with the fund and with your superannuation and how it's managed. You can also ask questions during this webinar by using the Q&A function in Zoom, which is, you probably know extremely well where that is, right at the bottom of the screen. And we'll answer we'll seek to answer as many questions as we possibly can. We will do the questions that were submitted first before the meeting, and then we'll get through as many as we can of those that are submitted during the meeting. But note again that at this meeting, we can only answer general questions about the fund. And if there are specific questions, then we request that you deal with one of our advisors after the meeting. If we can't get to your question, then we will ensure that the answers to your questions are put up on the website, probably within the next week or two, together with the minutes of this meeting. Well, that has dealt with the administrative aspects of what we're actually going to cover. So I now would like to introduce Danny Casey, the Deputy Chair of the board. Danny has served as our Deputy Chair since October 2019, when we initiated the joint venture with Equip, and prior to that, Danny was the Chair of Catholic Super since 2017. Will you welcome Danny Casey?
Thank you, Andrew. And thank you all for being with us today. I'm just delighted to have this opportunity to provide an update to you. Perhaps at the start, we look back and say the last 12 months by any measure has been extraordinary. And I suppose our view would be that what we've been doing, our years and our history of service, has put us in a position where we were able to help and respond. We think our history defined our capacity to respond during that challenging time. So just at the start of this first annual members meeting, I thought it might be useful just to trace some of the history that we've had, the journey of how we got to where we are today. It started in 1971 when Catholic Super was opened to benefit all those who worked in Catholic schools. In 2005, we became a public offer fund, open to all Australians. And then in 2015, we reached a new stage. Catholic Super became one division of the broader MyLife MyMoney superannuation fund. In 2016, we were joined by Transport Super, who merged with MyLife MyMoney. And then in 2019, MyLife MyMoney entered the joint venture with Equip Super, a fund with very similar backgrounds, aims, vision, and importantly, financial performance. So today, here in 2021, I'm pleased to say we can claim and highlight, should celebrate that we've been serving our members for 50 years. It certainly is a very special occasion. And while a lot has changed over those years, different logos, different names, and so on, what hasn't changed is our vision and our purpose. Our commitment to members has been constant all the way through. Our purpose is to give our members confidence and control over their financial future, to give them the very best possible retirement income that we can. Our laser-like focus on members' best financial interests is and always will be the foundation of all that we do. Now, in the financial year of 29-20, we entered the joint venture with Equip Super and its associated brands, which was our biggest move ever. It significantly increased our overall size and in turn has improved our ability to deliver our promise to members. I think the way we put the joint venture together was quite innovative. It enabled us to deliver benefits to our members sooner rather than later. It de-risked many of the costs and the benefits that can come when two funds join together. We have a license from APRA, which is called Extended Public Offer. It enables the trustee to be the trustee of multiple funds. And we were one of the first profit to member funds. And we're currently one of the largest funds to have gained an Extended Public Offer license from APRA. It allows us to join, to get alongside and to join together funds of a similar outlook, to get the benefits of scale, but to also maintain identity, creating a family of brands. It means we can have from day one chief executive officer, one chief investment officer, and a single board. But when you grow and you get the scale, it's much easier to attract highly skilled people. This increase in size of investable assets and the management capability has helped us develop an extraordinarily skilled team of board and executives, one of the finest we've ever had. This is just the start of our growth story. We're already exploring which other funds might be interested in joining with us to help grow and increase the benefits that we're already seeing. This was all delivered at the same time as ensuring that our members were supported during their time in need, a pandemic like we've never seen before. So while we continue to explore options for growth, one thing will never change: our absolute commitment to continuing to act in our members' best financial interest. Now, the joint venture was a logical step for two of the top 10 funds in the profit to member space, because we had very similar values, very similar outlook, very similar ideas, and very similar strong and deep commitment to serving our members. So two of the highest performing funds over the past 10 years coming together to improve the way they can serve their members. We've already derived significant trustee office savings since the JV was established in late 2019. These include board and management costs, as well as supplier savings. And we're going to benefit even more from additional savings when all the investments are under a single pool at the successor fund transfer stage of our merger and joint venture merger and integration. The JV has helped bring forward savings that have helped offset the one-off integration costs that always arise when funds seek to combine. And a key initial benefit is the investment manager savings. These come about because we consolidate managers rather than deal with multiple managers. And we also negotiate lower fees because we're talking about bigger scale. And we've realised in excess of $3 million per annum of savings to date, with more to follow when we have the single investment pool. And as we are a not-for-profit fund, well, all fee savings will sit in the fund and ultimately benefit you, our members. I mean, another big benefit from the joint venture is the diversification it offers, the diversification of membership. The joining of our membership bases means we now embrace more industries than we used to. Power, mining and infrastructure joined us from Equip. It joined us with the education and aged care sectors. The diversification of the membership base is an important part of the resilience. As we've seen in the pandemic in the last 12 months, it hit certain industry sectors much harder than it hit others. So looking ahead, we strongly believe that smaller funds that do not have the scale are going to really struggle to provide members with the benefits and returns that members deserve. That's what's underpinning our growth strategy. We do want to maintain our identity and connectedness to community. And that has been with us since we first started in 1971. We know our members have contributed so much to the community over the years, particularly during these challenging times of COVID. Many of our members have been very much at the front line serving the community. So we want to make sure we don't lose the individual identity and the values and heritage that we bring and brought to the joint venture. But we want to deliver the benefits of scale from being part of something bigger. And to help make sure we stay connected, we're establishing a Catholic Super Advisory Board, a channel for ongoing communication and advice to make sure as we grow, as we face into the future, we never forget where we've come from. As I mentioned earlier, one of the important benefits of the joint venture is that it's a much larger, more influential organisation. We can attract more highly skilled people and retain and develop and promote those we have within our organisation. This is the case with the board. We have a long-standing commitment with a skills-based board. Both funds did at the time of the joint venture, and it continues into the future. And why? Because we believe a strongly skills-based board delivers better outcomes for our members. We have a very robust process of reviewing our board every year, where we put a skills matrix and look at what skills our board needs for the future. And we appoint directors accordingly to make sure that the board has always got the skills needed that our members need to make sure we're looking after their best financial interests. In our skills-based board selection, we've committed to it 1/3 from members, 1/3 from employers, and 1/3 from independents. It's important that we have that connection from members and that connection from employers. And one great example on our board is Deb James, who's the General Secretary of the Independent Education Union in Victoria and Tasmania. So she works very closely with many of our teachers and education workers who are our members. Her capacity in governance is outstanding, and that blended with a deep understanding of the needs of our members and the impact on their workplace is incredibly important, and she brings that discernment to the table. Now, after our joint venture in October 2019, we grew to a board of 12, which has been a great transitional number, but we'll now be moving back to a board of 9 as at the 1st of July. And I think that's really the optimal number going forward. We're likely to stay there unless there's another significant joint venture or other similar opportunity that emerges over the times ahead. So 9 is what we're aiming for. And for any of our members who've expressed interest and I think wanting to put themselves forward, they've got skills that can make a contribution, then we are looking for a new member director position to start from the 1st of July. We'll be communicating this to members in the weeks ahead. And we certainly encourage you to apply. If you feel you've got the skills and if you feel you can make a contribution to our fund, then we very much look forward to receiving your application. And finally, one of the things that our joint venture has done is meant we could acquire a CEO of outstanding experience. And you'll shortly hear from Scott Cameron, who's the CEO of our new combined organisation. Scott brings a depth of commercial experience and member-focused experience to our team. And through very difficult circumstances, he's been joining our two organisations together, ensuring that we continue to serve each of our members during the challenging times, as well as the turbulent investment environment. By any measure, we're very fortunate to have Scott, and he's doing an outstanding job. And you'll hear from Scott very, very shortly. But look, our industry's certainly changing. We've seen lots of positive change in the superannuation industry over the past year, and it's all coming from a good place. It's all coming from putting members' interests first. Low balance or inactive accounts are now being transferred to the ATO and consolidated. Members will need to opt in for insurance in certain circumstances. This is particularly when they have a low balance or their account's inactive, or when they're under 25. And finally, members most recently have been allowed to withdraw money if they're suffering financial hardship during COVID. Further changes are undoubtedly likely in the times ahead. And so we think consolidation, which is being actively talked about, is now more likely than ever. You know, if you are a small fund, say 5 or 10 billion or perhaps even larger, it's going to become increasingly difficult to deliver the best financial interest to members. We think we're very well positioned for that change because altogether we manage around 28 billion in funds under management for 137,000 members. And our license, our extended public offer license, allows other funds to join us while we keep our identity and our branding. Yes, we are looking for further growth opportunities that will deliver additional benefits to our members because putting members' interests first will continue to be the core principle as we grow and as we achieve more scale. We passionately believe this delivers better outcomes for our members because we can attract and retain better staff, but we also achieve the efficiencies of scale. We have access to new investment possibilities that wouldn't be there if we were a smaller fund. So yes, we have a very clear goal to grow to 50 billion funds under management for all the funds we manage by 2025, with 300,000 members, and we're well on the track to achieving that. So for you as a member, this means access to better services, better experiences, more broader investment options. We already have options in mind for further growth by joining with other similarly like-minded superannuation funds. And our EPO license puts us in a terrific position to be able to achieve this. So we can look to maintain identity, we can look to build strong relationships and maintain the relationships with the communities and members of which we serve, while achieving the efficiencies of scale. We can bring forward benefits of combining sooner rather than later under traditional models. So we certainly see exciting times ahead, but we're enormously grateful for your support of our fund, for your support of our executive as we've steered through these challenging times. It's a privilege to serve you and to help you in your preparation for retirement. Please be assured your best financial interest remains our #1 priority. And now what I'd like to do is hand over to Scott Cameron, our CEO, to give you a briefing on some of the things we've got in flight in your fund. Thanks very much.
Well, thanks, Danny, and good afternoon, everybody. Look, as Danny mentioned, it's been a very difficult year for a lot of people. I'd like to thank all of you, our members, for your support and help throughout the year. But I'd also like to thank our staff, a number of who are dialing in to today's meeting. And they've put a tremendous effort in over the past 12 months and achieved some great outcomes during what have been very challenging times. And what they always do is they always put you, our members, first, and greatly appreciative of all of their efforts. Our team moved to 100% remote working very quickly early last year, or around this time last year actually, and coped admirably with Melbourne's very long lockdown and made sure our focus remained on giving you the best possible retirement income. In particular, I'd like to thank all of you that are essential workers and have done so much at greater risk to yourselves and to your families to help us get this far. I know we have many members, including our teachers, educators, nurses, aged care workers, transport and logistic workers who educate, care for and supply vital services to millions of Australians every day. So many essential workers put at risk during the pandemic. We couldn't have got through this without you. Danny mentioned earlier that the joint venture allowed us to put together a very strong board and senior executive team. And what's really important is that this is also true throughout the broader organisation. The joint venture has increased our size, and that's allowed us to put together a fantastic team with great leaders and specialists at all levels of the organisation. Our combined team has deliberately been structured to give us all the skills we need to meet our growth objectives, but as well as deliver our day-to-day services and stay on top of the ever-changing compliance landscape. We've brought complementary skills from both funds, and when we've needed to, we've brought new skills into the fund. Our investment team, headed by Anna Shelley, all have significant experience, an average of 20 years across the team. We're also great believers in the importance of diversity, and so we're very proud that more than 50% of our senior leaders and executives are women. We realised quickly that COVID, the pandemic, was likely to offer serious challenges to many of you, and so we moved swiftly to make sure we were there ready to help you. And we know that the reason we're here is to help you all gain financial freedom in retirement, so we made sure that we didn't lose our focus on getting a positive investment return for members. And our balanced option, which is where most members are invested, returned 0.5% for the last financial year. And I mean, that was simply a great result amidst a very difficult year where many funds lost money, and it put us in the top 25% funds in the balanced category. And we quickly transitioned our team to working remotely and put together a specific help hub and communication campaign to make sure you knew what was going on and how we could help you out. And we're delighted with the Net Promoter Score our service centre received during that time, which shows how many people really liked their interactions with us compared to the number of people who had an indifferent or poor experience. It's fantastic that so many of our members are getting good service when you get in touch with us. We're also pleased that we're able to help so many people gain access to their money if they were suffering from financial hardship or needed to change their investment options if the pandemic had disrupted their retirement plans. Danny talked about our history before, about our commitment to giving members confidence and control over their future. And that's what all of us work towards every day. As a profit to member fund, any increase we have in profit, any money we save, ultimately gets used to try and give you a better retirement. So the money we're saving as part of the joint venture with Equip, it's all getting used to improve our service to you or reducing fees. So I wanted to talk now about some of the things that we're working on. Digital. We're always trying to improve our digital services, as we know a lot of you like the flexibility of doing things yourselves and doing them when you want to do them. So we offer a digital service which helps members understand their products and manage their own transactions. We also have calculators that let you set out a number of different scenarios for your super to give you a better understanding of what's best for you. In respect to communication, we've expanded and improved our communications, including mid-year newsletters with balances, annual statements, personalised content, all intended to support members in maximising their retirement outcome based on their personal circumstances. In respect to financial planning, we know how important it is and how useful it has been for many of you. So we've expanded our team so more of you can get individual financial advice more quickly. We've enhanced our contact centre. Many of you have told us that while you really like using digital, there's sometimes that you want to talk to a person. So we've enhanced the capability and also the capacity of our contact centre, so it's easy to talk to someone when you need to. And this has been particularly useful during COVID when we've seen call volumes increase substantially. And insurance. We've refined and enhanced our insurance offer, and we've increased insurance claims expertise and also support. For most of the last financial year, the stock market performed very well, but then obviously when COVID-19 arose, the financial markets took their worst downturn since the global financial crisis. And we bucked the industry trend by delivering members positive returns for the financial year 2020, all except the aggressive option, which was neutral. And I think this was truly an excellent result, given that many funds had negative results. And of course, superannuation is a long-term investment. So while the annual returns are important, the longer-term returns are more important. So that's what we're really focused on. So as an example of our long-term returns, our default investment option, MyLife MySuper for members under age 51, this has an aggressive option, which has 94% in growth assets. And in the 10 years to the end of 30 June 2020, after fees and taxes, someone with an original balance of $150,000 would have had $23,430 more in their pocket than the average retail fund and $19,860 more than the average industry fund. Our objective for the aggressive investment option is to return 4% per annum above inflation over a rolling 10-year period. And we actually achieved an average of 9.2% per annum over a 10-year period. And so with inflation rate over the past 10 years at just over 2%, you can see we've performed very well and exceeding the objective by more than 3%. These results don't happen by accident, and I'd like to acknowledge the excellent work of Anna Shelley, our Chief Investment Officer, who you'll hear from shortly, and her team that have really done an amazing job in delivering these returns over the past year in very difficult circumstances. These are some of the awards which we've won by the different funds that are part of MyLife MyMoney superannuation. We're very pleased and very proud that these independent agencies have recognised the great value and the superior performance that our funds provide our members. So now I'd like to introduce Anna Shelley, our Chief Investment Officer, and Anna will give you more detail on our investment strategy, our performance, and the current economic environment. Thanks.
Thank you, Scott, and a warm welcome to all of our members. Before I talk about our investment performance and current economic conditions, I'll just explain a little bit about our approach to investment. So firstly, we focus on active investment management, which means being prepared to be different, where we see risks or opportunities to earn great returns on your money. And then we select specialist external managers who are experts in the field. And we do that in the same way that you might select a specialist surgeon if you needed one. We diversify your investments across different countries and different types of investments like shares, property, infrastructure and bonds in order to balance the risks. And we look for global opportunities which might not be available to individual investors to increase your returns and further diversify our investments. The aim is always to buy low and sell high, but that can be hard to do when you're managing your own money. We have decades of experience and we follow that discipline strictly. One example of the type of investment which we're able to give our members access to, which it would be difficult to get access to if you're managing your own super, is Quinbrook Low Carbon Power Fund, which is a specialist investment manager focused on low carbon and renewable energy infrastructure. It operates in the US, the UK, and Australia, and allows us to invest in wind, solar, battery storage, grid infrastructure, and reserve peaking power. It was actually awarded an ESG Investment Fund of the Year by ESG Investing and has returned 9% per annum since we invested in it in 2017. Now, I'll talk a little bit about responsible investments. We believe that environmental, social and governance factors, or ESG factors for short, influence the overall investment returns. So if we keep these factors in mind when we invest our members' money, it will increase the overall risk-adjusted returns for our portfolio. We know that many of our members have been concerned about ESG factors for many years, and we've been an early adopter of responsible investment. In fact, in 2006, Catholic Super became one of the first super funds globally to sign the United Nations Principles for Responsible Investment. We also introduced a specific responsible investment option in 2017 for members that wanted their investments aligned to their ethical values. The returns for that option, the positive impact option, have been very encouraging so far. And in fact, it's done better than conventional investments, but that can't be expected every year. It is a reasonably high risk option with more than 50% invested in listed global shares and other growth investments in infrastructure and property. So as well as our specific responsible investment option, we also take ESG factors into account for all of our investments. We actively promote strong ESG policies in our investee companies and also in the broader investment community. And we exercise our voting rights in support of good governance and a sustainable economy. Finally, in December 2020, to further reinforce our commitment, the board approved the adoption of a target for net zero emissions by 2050. And you might have seen this in the latest member newsletter. Now, I'll move on to returns. So as Scott mentioned, pleasingly, our long-term performance has been really strong. Our balanced option has returned 8% per annum for the past 10 years to 30 June 2020, and that's after investment fees and tax. It has 70% invested in growth style assets, and it's our default option for members who are 53 years and older. I mentioned that our overall approach is to diversify across thousands of different investments. We try and balance the need for long-term growth with the need for shorter-term safety when markets are rough, like they were back in March 2020. So this balance and diversification is just what's needed when markets are volatile and crashing. The objective for the balanced investment option is to return 3% per annum above inflation over a rolling 10-year period. And the average inflation rate historically over the past 10 years has been 2.1% per annum. So you can see that we've substantially exceeded that investment objective. It is important to note here that these figures are after investment fees and taxes. And I know that many of our members are interested in fees, and absolutely fees are something we're working to minimise as much as possible, and they will continue to reduce. But the most important figure really is your net return after fees and taxes, because that shows exactly how much your savings have gone up or down. Over the past 10 years, the median or average return for a comparable industry super fund is 7.1% per annum versus our balanced option at 8% per annum. So you can see that we've also substantially outperformed other super funds as well. Next, I'll just show you a slide with a range of our diversified investment options. And from top to bottom, you can see our more growth-oriented options down to our more conservative options, and our positive impact option is at the bottom of the table. Our investment objectives vary from product to product, and we have different products to suit people with different objectives, with different risk appetites, and also those who are at different life stages. You can see very strong returns over the last 10 years to the far right of the screen. You can also find out more and keep up to date on our investment returns on our website. Our default investment option, which I'll explain in the next slide, has members invested in a higher growth but riskier investment choice when they're younger. This is our aggressive option, which has earned 9.2% per annum over 10 years. We then slowly move members to the balanced option from the age of 50, and that option has still earned really strong returns of 8% per annum over 10 years. So this next slide shows how our default or MySuper investment strategy works. It takes into account that people who are further from retirement are generally better able to weather the ups and downs of a riskier, higher growth strategy in order to achieve higher returns over a longer time frame, so ideally over 10 years. And then as people get closer to retirement, they generally want less risk. They want to make sure that their capital doesn't drop dramatically just before they're about to retire and then leave them with a smaller total pool of funds when they're no longer earning a wage. Of course, you can tailor your investments with us depending on your particular financial needs or your own retirement plans. And we do offer a team of financial planners who are available to assist with any specific queries in relation to your investment choices. So finally, let me talk a bit about current market conditions. Equity markets have risen substantially since the end of June, up by 14 to 20% to the end of January. The market recovery has actually been one of the quickest on record. We invested a large amount of cash into equities as the market was bottoming last March, and that's really helped returns. The good news is our balanced option is up over 8% from the end of June 2020 to the end of January 2021. And our aggressive option is up nearly 10% over the same period. So that's a great start to this financial year and does make up for last year's slightly lower returns. So why have markets rebounded so strongly? This has largely been due to the strength of the stimulus provided by governments around the globe, and particularly in the US. Central banks have moved to keep interest rates low, and the market is very confident that rapid vaccine deployment will be able to contain the COVID-19 virus and minimise any ongoing impact. In the last few weeks, however, we've seen bond markets falling. So that means negative returns for many bond or fixed income investments. The strong selling in the bond market has occurred as investors have become less certain that interest rates will stay low for many years ahead. On the one hand, this reflects a market view of stronger economic growth going forward, so that's positive, but it also incorporates a concern that inflation risk is increasing and a concern about high levels of global government debt, which may not be sustainable. Bond markets can tend to be the canary in the coal mine, so this development is something we're keeping a close eye on. But we are well positioned for this. We only have very low holdings of bonds that are sensitive to interest rate movements. Cash rates also remain extremely low, and they are an ongoing challenge for us in delivering our investment objectives for you, particularly for those conservative style options that have large holdings of cash for stability and liquidity purposes. And as always, other risks remain, including the actual efficacy of vaccines, the rollout of those vaccines globally, the potential rise of inflation, and there are pockets of irrational exuberance in markets as well, US technology stocks being a good example, and also retail investor darling stocks like GameStop, which you might have read about in the news. Finally, the question of if and when stimulus might be removed from the system is another key risk. So in sum, we continue to balance these risks, and diversification of your investments remains a key tenet of our investment strategy on your behalf. We also provide investment updates on our website if you're interested. And now I'll hand back to our chairman, Andrew Fairley, for Q&A. Thank you.
Well, thank you very much, Anna. And thank you all. Thank you, Danny, for oversighting the sort of strategic direction of the fund, to Scott for the operational and financial clarity, and then the conversation that Anna has given us about investments really, I think, is very valuable for our members. I have a series of questions that have been given to us before the webinar started, so I'm going to commence with those. And the first actually deals with the issue of responsible investment. So I'm going to ask Justine to answer this question. And Justine, as Danny has said, I think I introduced her. She's the chair of our investment committee. And the question is, what are the efforts that are being made to invest in renewable energy and away from ethically unsustainable industries such as coal and tobacco? Justine?
Thanks for the question, Andrew, and thank you, Philip. I might actually take this question in two parts. I'll start by saying I'm sure you're aware that Catholic Super has been a leader in sustainable investments for many years, and our decision to commit to a net zero emissions target by 2050 is very much a reflection of that commitment. Now, in terms of renewables, your fund has got about $500 million directly invested in renewable energy. That's both domestically and globally, and that includes wind, solar, and waste to energy. We invest in the renewable assets themselves, as well as the grids and technology that make renewables more accessible. One example is the Copenhagen Investment Partners, and one of their particular investments is the Star of the South offshore wind project, which is under development off the coast of Gippsland in South Victoria as we speak. In total, we have about 1.8 billion invested across all sustainable investments. And these include more broadly property, infrastructure that have high sustainability ratings, and also assets in the healthcare sector that make an important social contribution. Now, in terms of the tobacco and coal, our sister fund, Equip, is a signatory to the Tobacco Free Pledge. And we're in the middle of looking at our current tobacco exposure, and we also expect to adopt that tobacco-free pledge. We do have some exposure in our portfolios to the metals and mining and oil and gas sectors, and I thought it might be helpful just to explain how we're thinking about those investments. So in regards coal, with thermal coal used to generate electricity, we're very conscious of the risk of stranded assets. With coking coal, we think that it has an important role to play in an ongoing basis in steel manufacture. And so we're focusing more on how emissions can be minimised in these processes, essentially how the transition can take place. And then more broadly, we think that there's a role for gas, iron ore, rare earths, copper. So we're not anti-mining, but we're very interested in how our investee companies are making that transition to be carbon neutral alongside ourselves. And you'd be aware that some of these companies are already investing significant amounts in the renewable space. We also partner with ACSI, the Australian Council of Superannuation Investors, and they help us with engaging with these companies to improve the advocacy and the disclosure of these businesses. And finally, I would draw your attention to our positive impact option, which takes a very strong position on the environment and has some of the most outstanding ESG managers globally, managing a dedicated portfolio of sustainable investments. I hope that's helpful.
Thanks, Justine. That's a really comprehensive answer, and I'm sure it will be the questioner will really now understand our position. Our next question is from John, and it's to Scott. It deals with our pricing. Why are the investment pricing only updated weekly and not daily in line with the ASX? Scott?
Yeah, look, it's a good question, John. We certainly understand that a lot of members are interested in moving to daily unit pricing, and it is something that we are currently investigating. There is obviously a lot of work and complexity around that, and so we'll update members as soon as we have something definite to report, but we certainly are seriously looking at the move to daily unit pricing.
Don't go away, Scott. I've got another question here for you. It's on member security from Gwendolyn. She's asked, what are all the security measures in place to prevent other people from accessing my account and my money by any means?
Well, no, it's a good question, Gwendolyn, because we want to make sure that all of our members' balances are safe and secure. Look, it's extremely important to us, and we have a range of security measures in place. I won't go into them all today, but I'll go through some of them. So, in respect of personal information, we make sure that it's secured and it's accessed only when absolutely necessary, and only when by authorised personnel. We verify members' identities before communicating with you. Before we update details or before we release information. We also apply enhanced security measures when we become aware of heightened risk on a member account. And so, for example, if a member advises us that they've had an identity fraud, for example, then we'll put a heightened watch on that account. We constantly monitor and maintain IT systems to detect malicious traffic and threats and prevent them. And while there isn't a common benchmark that rates security controls, we comply with APRA Information Security CPS 234, which governs information security for other entities also that are regulated by APRA. There's probably two other points I'd just like to make on information security. It's also the member can also play a part in this, and so just as you would with other forms, things like your bank account, etc. Don't share passwords, don't pass out personal information. Make sure things are secure at your end as possible. If you do have, for example, as said before, an account that's been or something that's been compromised, let us know, and then we can put a greater watch on it. And also, we've talked a lot today about the benefits of the joint venture and investing in certain areas, and information security is one that organisations, including super funds, are going to have to invest more and more in, and certainly funds of a larger scale can do that better. And that's certainly something that we see is an advantage as we progress through the joint venture, but also on our growth strategy. I hope that gives you comfort, Gwendolyn, that we're certainly taking the protection of your funds and information seriously.
And feeling more secure. Thanks,
Hopefully.
Gwendolyn. Yeah. Thanks, Scott. Our next question is from Mark, and it's to Anna because it deals with some detailed investment issues. He's asked, do any of the investment portfolios include investments in gold or gold stocks? Anna?
Yeah, so thank you. So yes, they do. They do hold gold-related equity investments from time to time. We hold them in both our Aussie and international equity portfolios. We also will hold some exposure to gold via derivatives in our hedge fund-related investments. But again, there'll usually be very small allocations there. And I'll just add, I saw quickly a question from Sylvia, I believe, in the chat. And we won't be able to answer it all fully today, Sylvia, but a concern about shorter term performance, we will provide a more fulsome response to you in our written responses. But just to emphasise that we do really focus on the longer term performance. Short term performance, particularly in the very volatile December quarter, is not something we focus on. We have recovered quite a bit of that performance in January to date and February again. So just to reassure you a little bit there. And she also asked about our Aussie equity performance, which has been improving, and we are making further changes in that Aussie equity portfolio. But as I say, we'll provide a more fulsome written response. Thanks, Andrew.
Thank you very much, Anna. The next question actually is another responsible investment question, which I'll ask Justine to deal with. Shane's asking, how are we balancing divesting from fossil fuel investments against maintaining returns? Justine, can you cope with this?
I can. Thanks, Shane. So our primary objective, obviously, is to maximise the retirement income of our members. And we also believe that incorporating environmental, social and governance considerations into our investment processes enhances the risk-adjusted returns for our members over the long term. So we don't see that there's any trade-off between achieving returns and investing sustainably. In terms of the environment specifically, the integration of climate change risk and opportunities into our investment decisions is really important to shift the global economy onto a more sustainable path and to protect our members' interests through this transition. Now, our preferred method of dealing with climate change risk has been through active ownership and engagement, and also collaborative advocacy, for example, through ACSI or the Investor Group on Climate Change. We'd like to be a driver of change, part of the solution. And so for that reason, divestment hasn't been a preferred approach for us. It's a bit of a blunt instrument in achieving a reduction in the carbon footprint of the portfolio. That said, I think in circumstances where after engagement, we cannot see any interest in reduction of emissions and that there's significant stranded asset risk, then divestment may well be appropriate.
Great, thank you. Thanks, Justine. Our next question deals with, it's actually got two limbs to it, and it deals with the trusteeship of Together Trustees as trustee of 3 separate brands. I might ask you, Danny, to answer this. It's why is there a reference to these 3 funds? And the second limb of that, which is unrelated to the first, is why did the pension legislation to halve the minimum pension amount get activated in July 2019? How did that happen? This is from Stuart, if you could answer those questions.
Well, thanks, Andrew, and thanks, Stuart. It's good to explain it. I mean, you see on my left, I think on your screen, there's multiple brands there, and that's because we are the trustee. We're looking after retirement outcomes of Catholic Super, MyLife MySuper, and Transport Super, as well as obviously the MyLife MyPension product. So we do look after multiple brands. I was hoping our presentation tried to explain some of that, so perhaps that might help. But look, if there's any further on that specific point, we'd be happy to unpack that further for you. The second part of the question is a really interesting one about the minimum pension drawdowns, which took effect, introduced by the federal government, took effect 1 July 19. So yeah, they were actually applied. The halving of the minimum drawdown rates was applied retrospectively due to COVID. And what we understand, I mean, it was a government initiative, but I think the policy intention was to ensure that our pension members weren't forced to draw down and cash out at times when the market was incredibly volatile. It may erode their capital base going forward. And so ultimately, for those members that didn't need the drawdown and certainly were able to operate at a lower level, were able to maintain more cash, or more investments, which would have led to taking full advantage of the recoveries that Anna mentioned earlier. Yeah. So listen, I hope that helps. Thanks very much.
Terrific. Thank you, Danny. I've got a couple of investment questions here. The first one is from Annie. Can you give us some thoughts on your expected rates of return over the next few years to come? Justine, can you deal with that?
Sure. Thanks, Andrew. It's an interesting question. So we are in an environment of very low interest rates and low inflation. So this is a low return environment, and we've been in this for a few years. So what does that look like? Well, if you look at the last calendar year, our MySuper returned 4.8%, and over the previous years, it's averaged around 6% per annum. But as we know, past returns are no indicator of the future. And as Anna mentioned, there are a number of risk factors now playing out in the market. So I suggest that the best rule of thumb is to look forward to your CPI plus target return for your particular option. So for example, CPI plus 3% over 10 years. And that 10 years is really important because it reminds us that super is a long-term asset and we need to be long-term investors. So when we're managing your funds, we're aiming to maximize the return for your given risk profile over that longer period. I hope that helps.
Thanks, Justine. I'm just having a look at my watch and we need to be completed by 5:30. So I'll deal with this question as our last question that we have time for, and it's from Vincent, and again deals with issues of ethical investments. In the investment update agenda, it said that we'll be elucidating our ethical investment principles, including our approach on climate change. Anna, can I ask you to answer this, please?
Sure. So thanks for that question, Vincent. You would have heard us talking earlier about our responsible investment principles, and also through Justine responding to an earlier question. So I don't want to repeat things that you've already heard, but basically climate change considerations have been built into the fund's investment decisions for some time. You can find out more on our website. We've got a climate change position statement that might be interesting for you to have a look at. And our responsible investing policy is also on our website. Specifically though on climate change, we do support the transition to a low carbon economy. We believe that the issue of climate change requires urgent global attention and action. And we've included a climate change transition roadmap as well in our soon to be published 2020-21 annual responsible report. And that report details the roadmap, which includes a high-level strategy, including setting a target of net zero emissions by 2050, also details some specific action items on each asset class. We'll be sure to keep members updated each year on our progress against that roadmap. Thanks, Andrew.
Terrific. Thank you very much, Anna. Well, it's almost 5:30 when we've been designated to complete our meeting. So I'm proposing to now close the conversation and to reinforce that the minutes of this meeting will be available on our website probably in the next couple of weeks, together with answers to all of the questions that we haven't been able to address today, and there have been a lot of them, although it's delightful to have Anna extemporaneously answering a couple of them as part of her comments today. There will be a survey, as you when we finish here, a question will come up, just asking you to comment on the way in which we've run the annual member meeting today. And it would be really helpful if you would fill that out, because we want some insights into how we might do this better, how we might talk more about some subjects rather than others, whether you want more or less questions, or any comments that you wish to make, please do so. And that will help us design the way in which we do our annual member meeting next year. So that's the conclusion of this inaugural annual member meeting for all of the super funds that you are members of. On behalf of our board and our management team, I want to thank you very much for taking time to be on the webinar today. It's really a great pleasure to be involved in serving such an engaged group of members, and we are certainly committed to ensure that we are acting at all times in the stewarding of your assets in your best financial interests. So thank you very much and good evening.